whether it's the value of the equity or the value of the firm, we're going to sum sum over all future years, the cash flows in each year divided by 1 plus the discount rate. So if we think about it from a theory standpoint, and how we put this into practice, for an asset to have any value, expected cash flows have to be positive at some point. So this is important, right? So if I'm doing a dividend discount model for a firm that's currently losing money, or free cash flow to equity, or free cash flow to the firm for that point, the free cash flows could actually be negative in early years. Now, you can't have negative dividends, but can have negative free cash flow to equity, free cash flow to the firm, as a firm is investing in itself, as long as they're investing in a way so that these cash flows in the future will be positive, the asset can have value. So that's certainly one of the things I'm going to be looking at when I value assets is, is it reasonable to assume at some point the cash flows are going to be positive? Now, if just from a time value standpoint, any asset that generates cash flow earlier, all else equal, is going to be worth more than later. All right, so one thing to keep in mind, I think sometimes the financial media, the news media really butchers this. You watch MSNBC, CNBC, all these financial programs, when they interview people and they talk about companies, and stocks kind of interchangeably. So when we think about, and I think this is an important thing to get in your head, the value of the firm is equal to the value of the stock, right, plus the value of the debt. And I think sometimes that gets ignored, right? So when we do a free cash flow to the firm model, we're discounting the cash flows that stockholders and bondholders can have reasonable claims on. So to our last step, to value the stock, we'll subtract the debt. When we do a dividend discount model or a free cash flow to equity, we're going right at the cash flows generated for the stockholders. But I think if you pay attention to the news, sometimes people will talk about, hey, this is a really good company, right? Well, I can identify a really good company, and it could be, something that's worth a lot, but it also might be priced fairly, right? So we have to keep in mind, I can have really good companies, really good firms that are actually priced in a way that maybe they're even overpriced, right? So we need to keep in mind, if I'm going to do equity analysis, if I'm trying to identify stocks that are trading for less than their value, they can still be very good firms, just that they're overpriced maybe right now. So really keep in mind the difference between a firm value and the value of a firm's stock. All right, if we get specific to the free cash flow to equity, so our direct approach, free cash flow to equity, so mathematically we could write this. We calculate the cash flow to the equity holders. So these are any residual stockholders. So we might start with net income, add back depreciation, subtract any reinvestment in the firm. We forecast those over time from year one to infinity, or the life of the firm. Discount each one of those cash flows by a cost of equity, and we'll talk about that later. Typically, we're going to estimate that using something like a capital asset pricing model or some kind of equity valuation model. We also recognize that a free cash flow to equity is a generalized, right, form of the dividend discount model. Dividends, we could say strictly that the dividends are really the only cash flows that stockholders have claim on. So we could substitute dividends as the cash flow to equity, or we could relax that and say, what could the company generate. And we'll get into a lot more detail when we cover the free cash flow to equity model later. Our next approach is the free cash flow to the firm approach, and that's where we're really going to start. We calculate the cash flows to the firm, cash flows generated to the firm. So basically with a free cash flow to the firm, we're going to start with EBIT times 1 minus the tax rate. Add back any non-cash charges like depreciation. Subtract any investment like capital spending and changes. So I'm going to use this capital delta, Greek delta, for changes in net working capital. And that gives me the free cash flow to the firm in each year. I discount that with a weighted average cost of capital. Again, we're going to spend some time talking about how to calculate weighted average cost of capital. And that's going to give me the value of the firm. To get from the value of the firm to a stock price, I will subtract debt. Typically, we think about subtracting long-term debt, not just liabilities, but long-term debt, money we'd have to pay the bondholders. That gives us the value of equity. We divide by the number of shares to get to a stock price. So just did a quick test to get from firm value to equity value. We take firm value, or often we call it enterprise value. Oops. Enterprise value. We subtract debt, typically long-term debt. We get equity value. All right, to sum up, if we kind of take a basic approach, we can think of these different approaches: free cash flow to equity, free cash flow to firm. In the end, they should give us the same solution. They should give us the same stock price. In reality, they won't, because we'll estimate things different. And that's kind of nice. From a practical standpoint, this gives us two very different tools to value the firm. So what I want you to do, take this little example, right? Maybe chunk it into Excel, try it this way. Discount these cash flows to equity. Discount these cash flows to equity with a cost of equity of 13.625. Come up with the value of the stock. Also discount these free cash flows to the firm. We can, we should be able to solve for the market value of equity, 1,073. Value of the debt's 800, so we subtract the debt. We should get the same stock price for each. Notice, though, this was really carefully constructed example so that everything lines up. In practice, I might calculate cash flows to equity. It might be easier for me to calculate these or estimate these than it is to estimate. So in practice, when we do these in practice, we can build models for the same models for a firm. Typically, we find that we don't get the same solution. And that's what makes the tools useful from a practice standpoint. One last thing we want to wrap up here talking about valuation. We really want to make sure we don't mismatch cash flows and discount rates, right? So if I'm valuing equity cash flows, I use a cost of equity. So something like a capital asset pricing model, or if we get more complex, maybe we use a 3 or 4 factor model. We want to discount equity cash flows with the cost of equity, and we want to do firm cash flows with a cost of capital that's appropriate for the whole firm, or a weighted average cost of capital. So those are something to wrap up. So if we think about just the theory, we're saying that the price of a stock should be worth the present value of all the future dividends. We can relax that assumption to say the price of the stock should be worth all the cash flows that could be paid to stockholders. Or we could take a different approach and say that the value of a firm should be worth the present value of all the cash flows that could be distributed to investors. So different approaches. We're going to later now get into the practice of how do we estimate some of these things.